All right, welcome back. Now that you've got a good understanding of the main types of investment methodology that you'll likely be using with your clients, it's time to pivot a little bit and spend some time on the more applied side of the course. Namely, what do models look like and what are they built with? Well, let's start with the basics, which are the building blocks that models are created with. At a high level, when creating an equity model to use with your clients, you've got two main categories of securities that are available to you. The first category is individual equities, and the second category is managed products. Let's quickly talk about these categories and the pros and cons of each, starting with individual equities. Individual equities are exactly what they sound like. These are the stocks or shares of individual publicly traded companies that have been selected for inclusion in the model and have been given a weight within the model. Picking individual stocks for an equity model is the purest form of modeling and puts all of the control, along with the associated risks and responsibilities, in the hands of the advisor running the model. What this often ends up looking like on paper is a list of securities or positions, often consisting of upwards of 25 or 30 individual names in varying proportions or weights. Depending on the model methodology in use, these equities may be sorted by country, geographic region, sector, market cap, or other attributes or factors. The downside to running a model in this manner is that it can be quite time-consuming and requires a lot of discipline from the advisor. You'll need to keep a keen eye on the market every single day, and specifically on all of the positions that you've included in your model, as well as any names you're considering adding. You're going to want to be in tune with macroeconomic trends, follow industry or sector news and events, and be familiar with the quarterly performance of each name in your model. Doing all of this is your responsibility as an advisor, and should you drop the ball, you could be personally liable for the financial damage you cause your clients. So be sure that you're well prepared and have established adequate processes and controls before creating and deploying your proprietary equity model. Now, those are the risks of using individual equities. But doing so also comes with a lot of benefits. The first of these is the value that you'll bring your clients. Every client who has an allocation to your model is going to see each individual security, each individual trade that you execute when making model changes and rebalancing, and will see each dividend payment hit their account. This is going to give your wealth management service more cachet with the client and will make the experience feel much more bespoke and white glove when your client reviews their statement. They'll be able to better understand your unique strategy and investment philosophy, and when holding review meetings or providing portfolio commentary, you'll be able to discuss with your clients the winners and losers in their portfolios, which most contributed to their overall performance. Another benefit to using individual securities is the cost. As we know, wealth management clients typically need to pay a fee to your firm for your investment services, plus any additional costs associated with their holdings. Managed products like mutual funds, ETFs, and hedge funds always come with an added proprietary fee called a management expense ratio, or MER. By using individual securities in your model, you can keep the total cost to your clients low, thereby making you more competitive in the market relative to your peers. This is going to make you very attractive to prospective clients, especially those with extremely large sums of money to invest, where every basis point can make a material difference to their performance outcome. The last benefit to individual securities that we're going to discuss is customization. Should your client wish to exclude certain types of securities from their portfolio, such as gambling companies, tobacco producers, or even weapons manufacturers, you can meet their requirements with relative ease. This is often very difficult to do with off-the-shelf managed products. So, with all of those benefits described, why would an advisor choose to include managed products in their models? Well, for starters, they can be less risky. If an advisor doesn't have the processes or the expertise to manage their own model of individual securities, they can allocate part or all of their model to a single fund or a basket of managed products, which will give them the equity exposure they're looking for with the added benefit of oversight from a qualified portfolio management team. This means that the advisor can spend less time monitoring equity markets and more time doing things that deepen relationships with clients, like holding review meetings, generating financial plans, selling other products and services like insurance or trust advice, or spending more time growing their practice through networking or other business development activities. Another benefit to using managed products is access to opportunities. Think back to our course on alternative investments for wealth managers. Sometimes an allocation to a hedge fund or a private equity fund, sometimes an allocation to a hedge fund, a private equity fund, or a venture fund is the only way to get exposure to certain strategies or types of investments. When thinking about ultra high net worth clients who already have a fully diversified equity portfolio, often you need to look to these types of managed products for additional diversification or performance benefits. Whether you choose to build your model out of individual equities, out of managed products, or a combination of both, there are some best practices to keep in mind which will ensure your chosen model or models will integrate seamlessly into your practice. First of all, in order to manage a client's portfolio as cleanly as possible, make sure that your equity model only contains, well, equities. This may sound like a no-brainer, but you'd be surprised how easily a fixed income allocation can sneak into a model, especially when you're using managed products. Many mutual funds and ETFs, and especially those labeled balanced funds, will include a fixed income component to their fund. Always ensure you've got a detailed understanding of any managed product you choose to add to your model so that you're managing your clients' funds correctly and according to what's detailed in their IPS. If you're not sure, you can always go online, go to the asset manager's website, download the prospectus for that particular product, or reach out to the asset manager's sales team. They will be able to tell you exactly what's contained in any of their products and will give you the peace of mind that there's no fixed income allocation to an equity fund before adding it to your model. Next, try to make sure that every position in your model is as liquid as possible and make yourself aware of any liquidity concerns or constraints early on. For example, small cap, thinly traded stocks may not always be easy to trade due to low volume and liquidity, making getting in and out of these positions difficult and potentially expensive. Other products like structured notes can only be bought and sold from the dealer that manufactures them, but you can't buy more of the same note a client already owns after the issue date. This makes rebalancing and deploying additional capital challenging if that note is part of your model. We've also talked in previous courses about trading windows. Some hedge funds only trade on specific days of the week or the month, which is something else to make note of. Additionally, make sure your model has an established mandate. For example, if you're running a US large cap equity model, establish rules and criteria for security inclusion, and be sure not to deviate from those rules even when a lucrative investment opportunity is tempting you. The last thing you want is for a client to be under the impression that their funds are being invested in large cap stocks, only for them to see mid and small cap equities making their way into their portfolio unannounced. Lastly, choose a valid benchmark for your model. Typically, model performance is measured against a valid, unmanaged index like the S&P 500 or the Russell 3000. By having this comparison available for any time period, both yourself and your clients will be able to see if their equity allocation is underperforming or outperforming the market. So, we've done a lot of talking about the different types of models that are out there, what methodologies drive their construction, how they're built, and what they're built out of. Now it's time to see some of those concepts applied in practice. Part of today's course package included a pair of spreadsheet-based equity modeling tools that I'd like you to have a look at now. Each tool contains an example of a real-life equity model for you to dig into and consider for your own wealth management practice. The first is an equity model which was constructed entirely out of ETFs, and the second is an equity model that was constructed out of individual stocks. Let's take a moment to walk through each model and run through a few types of scenarios that you could run into in a real wealth management practice. We're going to start with the ETF model. Once you've got the spreadsheet open, you're going to notice that this spreadsheet was built on a standard CFI template. What that means is that the cells with blue text are inputs, like the allocation amount and the model weight, and the cells with black text are either static fields or outputs that are driven by the model itself. You're also going to notice that there are 4 individual positions that are part of this model, and that each has a description next to it, which tells you a little bit more about the strategy that drives that particular security. In this case, these are ETFs. For this model, we've selected 4 individual managed products to provide clients with exposure to a wide range of equities by geography. I mentioned that these are ETFs. So you've got 2 North American products, a US equity fund and a Canadian equity fund, and then a fund that's focused on developed international markets like Japan, the UK, and France, and a 4th that's focused on developing international markets like China, India, and Taiwan. This simple set of managed products can give you as an advisor a lot of flexibility in terms of what you offer your clients in their equity allocations. Let's take a look. The first thing we need to do is fill in the blue inputs on the spreadsheet. The first input at the top is the allocation amount. This is the amount of investment capital that we're going to be deploying. For this scenario, what we're going to do here is input $1 million. What this does is simulate a client who's depositing $1 million into their investment account, which we're going to fully allocate to this equity model. The next inputs we need here are the weights for each individual position, which you'll see as an input under the header called Model Weight Position. As we just covered, in our example, each position is differentiated from the others in the model by geographic region. What this means is that when we increase the weight of any particular position, we increase the exposure that our client has to equities in that specific part of the world. Let's start things off by creating a global equity model that's biased towards North American equities. We're going to input a weight of 20% in the Canadian equity ETF, a weight of 50% in the US equity ETF, and then weights of 15% each to developing and developed equities. This totals 100%, and it's worth mentioning that the sum of our individual position weights must always total 100%. With those weights in place, you can see the dollar amounts for each position filling themselves in, which gives you a sense of how this client's capital will be allocated. The client's funds are tilted towards North American investment, but will still allow for participation in upside from a range of global markets. Let's move on to the next scenario. In the next scenario, we're going to work with the same managed products as before, but in different individual weights. Let's suppose that the global model that we defined in the first scenario has now been in use for several months, and the global economic outlook has changed. Previously, the North American economic outlook was very positive, and we had allocated the majority of the model weight to US and Canadian equities. Now that's changed, and the developing world represents the best opportunity for investment. So, how would you allocate this model? Pause this video and take a stab at selecting the model weights yourself, and then start the next video when you're ready to compare to what we would do. We'll see you there. Welcome back. Let's see if our allocations are similar. As advisors, in order to capitalize on this investment thesis, we would now like to increase exposure to equities from developing economies. Doing so is fairly straightforward. We're going to start from the bottom up. First, by increasing the position weight for our developing economies ETF from 15% to 40%. Next, we're going to increase the weight of our developed economies ETF from 15% to 20%. Lastly, we'll change the weights of the US and Canadian ETFs to 20% each. Now, let's do a quick check. Does the total equal 100%? It does, and we're good to go. We've now tilted our global model away from North America towards the developing world, and you can see how the value of each individual position has changed along with that. That takes us to the last scenario for this ETF model, which is to create an equal weighted model. Give it a go, and we'll see you in the next video. Welcome back. As you've probably guessed, an equal weighted model is exactly what it sounds like. It's a model where each individual position weight is the same as the rest. Now, in this scenario, we don't have a clear preference for any specific geographic or economic region, and would instead prefer to give our clients exposure to a basket of global equities. In order to do this, we're simply going to set the position weight of each of our ETFs to 25% each, rather than slanting the model towards any specific position. Now that that's done, we just need to check to make sure that the total is equal to 100%, which it is, and we're all done. In the next few videos, we'll work on the second model, the individual equity allocation model. Open that up and we'll see you there. Let's move on to the next example, which is a model constructed out of individual equities. To do this, we're going to open up the second spreadsheet that was a part of this course package, which, if you take a look at the spreadsheet, you'll see that we've grouped each company by the industry or sector that they're a part of. And we have a number of sectors in our model, like consumer staples, energy, financials, and others. As we scroll through the list, you're going to see a lot of names that you're super familiar with, like Target, Costco, Domino's, Goldman Sachs, Microsoft, Barrick Gold, Verizon, and others. This model calculator works the exact same way as the ETF model calculator did, but we've got far more position inputs to worry about as we're managing this model to a far more detailed level of granularity than we were in the last example. Let's start things off by once again inputting an allocation amount. This time, we'll suppose that we're dealing with a much larger client, and we're going to input $2 million into this cell. As you can see, we've already pre-filled in an initial set of position weights. And now that we've input an allocation amount, the value of each position is also on display. At this point, we're going to run through a few more scenarios which might prompt an advisor to make a model change. You're going to notice that while in the previous, more simple ETF example, we only had to think about economic outcomes at the macro level, things get a lot more complicated when you're managing individual equities. Because of that, we're just going to have you follow along for the next few scenarios. We'll see you there. Let's start with the first scenario. In this scenario, let's suppose that new banking regulations are brought in to strengthen the US financial system, and the regulator has implemented a domestic stability buffer for banks, requiring them to maintain a Tier 1 equity ratio of 12%. Now, if we look at the financials section of our model, we've got 7 different US based financial institutions listed, and these will all be impacted by this change in regs. We know from previous analysis that Wells Fargo and Morgan Stanley have the lowest capital levels and will be the most challenged amongst their peers to grow their balance sheets. Thus, as advisors, we believe it prudent to reduce exposure to these two names in order to protect our clients from negative fallout that this reg change may cause. What we're going to do is reduce the position weight of Wells Fargo from 3.5% to 1.5% and reduce Morgan Stanley from 6.6% to 2.5%. As we scroll down to the bottom of the calculator, you can see that we're now only at a total of 93.9%, which means we have 6.1% of the model to redistribute to other names. For the sake of simplicity, let's suppose we're still very bullish overall on financials and would like to maintain the previous sector weight that our model had adopted. So what we're going to do is increase the position weight of Goldman Sachs by 3% by increasing its weight from 3.7% to 6.7%. And we'll increase the weight of US Bancorp by 3.1%, increasing its weight from 3.7% to 6.8%. Now, a quick scroll down to make sure we're back to a total of 100%, and we're done with our changes. Now we're going to move on to our second and final scenario. Take a look at our current sector allocation to energy, which is currently sitting at a total of 17.4% of our model. Now, for this scenario, let's bring some geopolitics into the mix. Suppose the US has a large diplomatic breakthrough with Venezuela, which results in the long-standing sanctions that Venezuela has been subjected to being removed. Because of the removal of sanctions, Venezuela is now able to sell the crude oil that it produces on international markets. This rapid increase in the global supply of crude, without a corresponding increase in demand, has the effect of lowering oil prices. As advisors, we're concerned that this change will negatively impact the profitability of US energy producers, and we want to reduce the sector allocation altogether. In order to do this, we're going to reduce the weight of each individual energy position by 2%, starting with Exxon, then moving to ConocoPhillips, then Valero, Marathon Oil, and finally, Diamondback Energy. As you can see, after making those changes, our total sector allocation to energy is now at 7.4%. If we scroll down to the bottom of the calculator, we can see that the sum of our position weights is at 90%, which means we can reallocate 10% of our model into a sector that we have a more positive outlook on. In this case, we're going to make the thesis that low oil prices are going to translate into lower transportation costs, which will mean that the average consumer has more disposable income in their pocket. As such, we're going to increase our exposure to the consumer discretionary sector, which tends to perform well when consumers have more money to spend on luxuries. We'll do this by increasing the position weight of Target and Magna, each by 5%. So Target is going from 2.6% to 7.6%, and Magna will go from 3.3% to 8.3%. Once we have those changes in, we can see that the sector weight for consumer discretionary is now at 15.9%. And if we scroll down, we see the sum of all position weights is back up to 100%. This is just a small set of examples that demonstrate some of the many different ways that changes in the market can necessitate a change in an advisor's model. Spend as long as you'd like practicing with the allocation spreadsheets, and then we'll move on to the next part of the course: sourcing your models.